There's been a lot of talk in this last week about the upcoming changes to credit score and interest rates. Now, like anything, there's clickbait and there's truth. So what's the difference? I'm going to break this down for you in the next 2 minutes to help you explain it to your clients, your friends, your family in a very easy manner. The first thing you need to understand is an LLPA, or loan level price adjustment. What that means is it is a risk-based price adjustment. So as an example, if you have an 800 credit score, you get a slightly better interest rate than somebody with a 600 credit score. Now, why is that? It's because the 600 credit score is a higher risk. It's a higher risk when they sell the loan, it's a higher risk for default, higher risk for foreclosure, and therefore they hit them a little bit on the interest rate through the LLPAs. They make their interest rate slightly worse. Now they're going to be changing this. They're going to be changing it to where the people with the great credit scores are now not going to, they're going to kind of not get quite as much benefit. The people with the low credit scores are going to get a little bit more benefit. But keep in mind, it doesn't level the playing field. It's not going to be the same. So you're still going to be better off with that good credit score than if you had the bad credit score. Now let's take a look at this heat map. You're going to really be able to see where these adjustments make the biggest impact. The part that's a little bit confusing to anybody in this industry is you look between 720 and 759. That's going to be the bulk of buyers that we have, and they're getting hit the worst. They're going to hit the hardest between 80 to 85% loan to value. It's a very odd target to be able to hit. But then you're going to look at the lower credit score, below a 639 credit score with a low down payment, a high loan to value, and they're actually getting the biggest benefit from these changes. These changes could equate in the worst case scenario to about 1/8 of a point in interest rate. Now that's going to be the equivalent of about $40 a month. Now that's not that big of a deal, but it's not right. It's not fair. It's fundamentally wrong. They feel like they're Robin Hood, taking from the rich and giving to the poor, but what they're actually doing is they're taking from people who've worked really hard to get their credit score, because this is not income-based. This is not wealth-based. It's not, how much of a house you're buying based. This is strictly off of people who've worked really, really hard to get their credit score where it needs to be and taking care of their bills and taking care of the things they need to take care of. Those are the people that are being hit. So while the $40 may not seem like that big of a deal in a lot of circles, it may not. But again, the foundation of it, I think, is very wrong. It makes you wonder, is FHA the better deal now for a lot more income categories? Let's think about this for a minute. Traditionally, you think FHA is, oh no, that's for lower income, lower credit. But FHA did just lower their mortgage insurance premiums, and their credit scores are traditionally a good chunk better than conventional. So when you're out shopping, don't discount FHA. You want to look at FHA. Now, if we can do anything else here at 719 Lending, please let us know.